In today's video, I'm going to show you when gold should be a part of your investment portfolio and when you should completely avoid it. Hey everyone, I'm James Conole, founder of Root Financial, and I'm here to show you how to get the most out of your life with your money. When people talk about gold, there's a whole bunch of different things they say. They say it's an inflation hedge. They say it helps you to diversify. They say it's something that preserves its value better than anything else. And there's some truth to some of those statements, but there's also some serious downsides to gold. So in today's video, what we're going to do is we're going to walk through what role should gold play in your portfolio, what are the pros and cons of this investment, and how can you make the decision that's best for you as to whether you should invest in gold or not. Now, for me, when I'm looking at any investment, there's three considerations that I want to make. Not just anything makes its way into my portfolio or into clients' portfolios. And at a high level, there's three things that I want to consider. Number one, does this investment make sense? Is there a logical reason why this investment will make money and be something that's good for me or for clients over time? Number two, is performance persistent? Not only does it make sense, but does it deliver? And not just deliver over short periods of time, but deliver over long periods of time in a way that's persistent. And number three, is this an investment I can stick with? Through ups and through downs, is this something I have faith in that will deliver good long-term returns? So those are the three things that I like to look at as a starting point for does an investment make sense? Let's see how these play out in the context of investing in gold. So number one, does this investment make sense? In other words, does it pass the sniff test? Is this something where there's a logical reason why if I put my money in this investment, it will grow for me? Now, sometimes to best understand this, it's best to understand it in the context of what doesn't make sense. What's something that doesn't make sense that people have historically invested in, so you can see the antithesis of what I'm talking about here. A recent one was in the 90s with the Beanie Baby craze. Now, when you look at a Beanie Baby, it might be a really cute little animal, but these are things that were costing a couple bucks to manufacture, and people were quite literally paying thousands and thousands and thousands of dollars to own these. And they were doing it because they thought these Beanie Babies would be worth even more later as a collectible. Now, when you think about that, is that an investment that makes sense? Well, you have this little stuffed animal. It doesn't generate revenue, it doesn't generate profit. There's nothing to this that makes it make money. It's entirely built on speculation. Now, that's the hard piece, because when you look in the 90s, 10% of all eBay sales at one point were Beanie Babies. You had these Beanie Babies that you could buy for a few bucks and were later selling for tens of thousands of dollars in some cases. So there was this mania, there was this craze, but when you look at it, if you could separate yourself from the mania, you can see this really doesn't pass the sniff test. There's really no logical reason why this little stuffed animal might be worth thousands and thousands of dollars. Another example is the dot-com bubble. Around the same time, actually, as the Beanie Baby craze, the dot-com bubble was going crazy. Now, when you look at this, did it make sense why some companies with zero revenue, zero profits, really no great business model should be worth millions and millions and millions of dollars simply because they had a .com in their name? No. Now, in the moment, it's easy to get caught up in that hype. In the moment, it's easy to get caught up in, well, it's going up in value, therefore it must be a good investment. But this is why it's really important to, number one, does this investment make sense? Is there a good logical reason why if I put my money here, my money will make more money for me? Now, we could go all the way back to 1720. This isn't a recent phenomenon. In 1720, you had the tulip bulb craze. And the tulip bulb craze was something that was just overtaking many parts of the world where people were investing in tulips and tulip bulbs, to the point where Sir Isaac Newton, the man who literally discovered the laws of gravity and motion, he lost the equivalent of $3 million in today's dollars in the tulip bulb craze. So if you're ever kicking yourself for something dumb you spent money on or a bad investment decision, just remember the man who literally invented calculus has also been caught up in these same manias. But when we look at this is why this is number one in terms of asking ourselves, does this investment make sense? Does it make sense that tulip bulbs should be worth a ton of money? Or .com stocks should be worth tons of money when there's no revenue and really no sound business model? Does it make sense that Beanie Babies should be worth tons of money? Now, what does that have to do with gold? I'm just showing you what we shouldn't be doing or how to filter this out. When it comes to gold, you have to ask yourself, is there a real reason why this makes sense? Now, in some ways, yeah, it does. There's some practical purposes for gold. It's maybe used in jewelry or different things. But the biggest thing with gold is it's generally accepted to hold value. There's no cash flows, there's no revenue. Unlike a stock, where if I go buy a stock or if I have an investment in a company, I have an ownership right in future revenues and cash flows of that company. With gold, I have none of that. So you have to ask yourself, does that make sense as an investment? Yes, there's some practical purposes, but the main reason gold has value is because we believe it to have value. There's nothing inherently that has value in it, except that in most people's minds, there's value. And enough people think there's value in something, then it holds value. But you have to ask yourself, is there a logical reason why this has value? Not just because I hope someone will pay me more money for it in the future, but is there a true reason that I have faith in that this investment holds value? That's number one. So the second thing we want to consider is performance persistent? I could believe with my whole heart that something has value. But if there's no performance there, what it's telling me is the rest of the market doesn't believe that there's value there themselves. So we have to look at this to say, is there a track record of success? So let's explore that. Let's look at the performance of gold, but then let's compare it to the performance of the US stock market so we have something where we can compare not necessarily apples to apples, but at least two options that each investor has to invest in. So let's take a look. As you're looking at this here, and I have a chart here on the side where you can follow along with me, what I've done is I've compared the performance of gold versus stocks. Now, for some context here, we have to understand the history of gold to really understand this performance in context. From the 1930s until the early 1970s, the price of gold was pegged. Because gold was used to back up US currency, the government passed a law where you literally could not own gold bullion unless you had a special license to do so. So they did this because gold was backing the US dollar, and so they pegged the price of gold at $35 per ounce, and it stayed that way from the 1930s all the way to the early 1970s. So to compare the performance then, well, the performance was zero because it was artificially pegged. So what I'm going to do here is I'm going to say what was the performance of gold from 1972 and beyond, because 1972 is the first full year that we were taken off the gold standard. So as we look at these numbers here, you can see from 1972 to 1979. So call that the 70s. The 70s after we were removed from the gold standard, gold had an incredible annual return. This number 36% here, that's not total from 1972 to the end of 1979. That's average annual return. So that's 36% per year on average, which is a really incredible return. You compare that to the US stock market, US large cap stocks, they grew at about 4.6%. Let's go to the 1980s. After an incredible 8-year run for gold from 72 to the end of 79, they didn't have such a hot run in the 1980s. Gold lost 2.5% per year for an entire decade straight. For context, that's over a negative 20% cumulative return during the 1980s for gold. You compare that to stocks, they grew at 17% per year over that same time frame. Then in the 1990s, what you have here is once again, gold had a pretty lousy decade. Gold lost 3.3% per year from the beginning of 1990 all the way to the end of 1999, and compare that to stocks, which grew in the 1990s at 15.3% per year. Pretty incredible return. You can see here in the table right beneath this, I say gold cumulative and US large cap cumulative. What that means is from 1972 until the end of this decade, what's been the average return over that time period? So if we go to the 2000s, you can see here gold up about 14%, US market lost 1% per year. 2010s, gold right around 3% per year, US market at 13.4%. And then 2020s, so that's 2020, so January 1st of 2020 until August 2022, what we see is gold's averaged about 5.5% relative to US large cap stocks at about 11.5%. As we look at this from 1972 until today, until August 2022, the average return for gold is about 7.4% per year. And the average return for large US stocks is about 10.5% per year. So that's some basic comparison for you. Now, you might not think that's a whole lot. Okay, that's 3% per year, but consider this. Had you invested $10,000 into gold in 1972, and you'd also invested $10,000 into the US stock market, large cap stock market in 1972, here's what that $10,000 would have done for you. Had it been entirely invested in gold, you'd have grown to $375,000. That's not bad. That's a pretty significant return. But when you compare that to investing it in US large cap stocks, that $10,000 would have grown to over $1.53 million. More than 4 times what you would have had you invested in gold. Now, when we're looking at performance, that alone is not the best comparison. Because I could look at the performance of short-term bonds, for example. It's going to be horrible compared to the performance of an investment in stocks. Now, the difference is the risk is much lower in short-term bonds than it is in stocks. So the real question here is the return proportionate to the risk we're taking or the uncertainty that we're accepting? There's different ways to measure risk, but one of the most common ways is through something called standard deviation. Standard deviation is just a way of saying how much does the actual performance on a year-to-year basis deviate from the average return. So if I have an investment that grows at 10% per year with a 0% standard deviation or a 0 standard deviation, that means I get 10% every single year. That would be an amazing investment. Unfortunately, it doesn't exist. So what you want to do is, can I get a percent return with as little standard deviation as possible? For context, the standard deviation of the US stock market over this time period that we're looking at, when we're looking at gold performance versus US stock market performance, the US standard deviation is 15.3%, which maybe means nothing, but gold standard deviation is 19.9%. So what we can see is the risk of investing in stocks over this time period was lower and the return was higher. Now, it's not just standard deviation that is risk though. One of the things you want to know is, can I count on my money being there? So what I like to look at is, what's the worst possible drawdown? So from 1972 until now, what's the worst drawdown? So how far did the investment fall and how long did it take to recover? Because if I'm going to invest in something, I want to know that that money is going to be there for me and I don't have to wait 20, 30, 40 years for it to potentially recover. Well, let's take a look. When you look at gold, its worst ever drawdown was it lost 62%. Now, not only did it lose 62%, but it did so from October 1980 to August of 1999. Meaning that was almost 20 years of declining performance. It took until April of 2007 to break even again. Meaning over 26 years, you had a 0% return. When you factor in inflation, you had a negative real return. We'll compare that to stocks. They were down about 51% or so from 2007 to 2009. Now, if you look at that, that certainly wasn't fun. But had you remained invested, those stocks would have fully recovered if you stayed invested, continued reinvesting dividends by August of 2012. So fewer than 5 years. So as we're looking at risk, we have to understand the context that we're looking at it. US large cap stocks, what's the performance? Gold, what's the performance? We see the US large cap stocks outperformed over this time period and did so with less risk. Now, in a sense, this makes sense. When you're investing in stocks, you're investing in companies that have cash flows. I'm not buying stock in Apple because I really believe Apple has value. People buy stock in Apple because they have a right to future cash flows. As Apple sells more iPhones and iPads and services, what you as an owner get to participate in that. You have a future claim, or you have a claim to those future profits. If you invest in gold, there's no dividends, there's no revenue, there's no profits. You are counting on, is someone else going to pay you a higher price for it in the future? Now, the third point when it comes to, is something a good investment, is will it let you stick with it? Or is it going to make it easier to stick to your investment plan? Here's why I bring that up. Some people just are not comfortable investing in the stock market. They've had a horrible experience. They saw something that went wrong. Maybe they think the stock market's rigged. Whatever it is, some people just aren't comfortable with it. But they're very comfortable investing in gold because they believe in it. They think it's something that's going to be worth more in the future. Now, I don't think that's the case, but I know plenty of people that they have gold as part of their portfolio, and because of that, it allows them to stick to their investment plan. It allows them to remain calm and remain committed to their strategy, even as things are going up and going down. So in that context, even if on paper, gold underperforms stock investments or other types of investments, if it allows you to stick with your investment plan, there's something to be said for that. There's something to be said for what's going to motivate the right behavior, keep you on track, and allow you to realize the goals that you have. So do I believe it's speculative? Yes, I believe that gold is largely speculative and there is a component of it that's based on true value. Now, my opinion is that, but I also have clients and people who have invested in gold, and I don't necessarily recommend it, but I'm very much okay with it because it allows them to stick to their plan, stick to their portfolio, feeling like they're more diversified and have more of a hedge against inflation or other things like that. So that's the way I like to look at investments. I like to look at it through the context of 1, does this investment make sense? 2, is performance persistent? And 3, will investing in this investment help me stick to my investment plan? For you, as you explore gold, you have to come up with your own decision on that. I personally don't love it, but if it accomplishes that third goal of allowing me to stick to something or allowing a client to stick to something, then that absolutely shouldn't be something that's discounted. And gold is one of those investments that people just really feel strongly about, regardless of some of the past performance. Real estate is also one of those investments. If you're thinking about how does real estate also fit into your plan, be sure to check out this video above. Once again, I'm James Conole, the founder of Root Financial. If you're interested in seeing how we help our clients at Root Financial get the most out of their life with their money, be sure to visit us at www.rootfinancialpartners.com.